All right, everyone, welcome back to part two. We're going to begin talking about life insurance policies, different types. So remember that we figured out how much we need, and now we're going to think about which type of life insurance is best for us. By far, the most popular is term life. And so term life is just like what it sounds. You have life insurance coverage for a set number of terms. For example, for a set number of years. For example, you might be covered for 10 years, which says that if you die within 10 years, your family, your dependents will get paid. If you die after 10 years, then you would not get paid from the policy. Your dependents would not. Coverage is unchanged throughout the term. So typically people will buy for example, 10-year, $100,000 policy, which says if I die in the next 10 years, my loved ones will get paid $100,000, regardless of which year it is. And lastly, the most common type of premium payment is level. And now you can agree to pay higher in the beginning and lower at the end in different schemes, but the most popular and the most widely offered are level premiums, which you'll pay a monthly premium or annual premium for life insurance. Remember, premiums are your contribution to the insurance pool. So let's think about what determines that premium. The price you pay. Recall that underwriters and actuaries are trying to figure out how likely you are to die. And if you are more likely to die, they want to charge you a higher price because it's more likely that you will make a claim against them. So true or false, longer term policies have lower premiums than shorter term policies. You should be thinking about, is the person more likely to die in a 20-year policy or 10-year policy? Well, this statement, even though it has a question mark, is false. Longer term policies actually have higher premiums. And so we can see that if we go look at a Allstate's quote estimator. So what I've done here is I've picked a male born on this day about 30 years ago. They're 5'10", 185 pounds. And you'll see all the information you give them for this quote. Not a smoker. Do you have any medical issues? Alcohol abuse. Do your siblings or parents have alcohol or have medical issues or alcohol abuse? How many traffic tickets have you gotten? Right? They're trying to figure out how risky of a person you are. Have you ever had any DUIs? Are you a private plane pilot, or do you participate in hazardous sports, excluding recreational scuba diving not exceeding 60 feet? So interpret that one as you will. And so I've submitted this, and you can see this person for a 10-year policy will pay $25 a month. For a 30-year policy, they're going to pay almost $49 a month. So the longer the policy, the more likely this person is to die and make a huge claim for this $550,000 policy. That's a big payout, right? So the insurance company is going to say, all right, it's more likely to happen in 30 years. We want to recuperate as much as we can through premiums. Okay. Let's try another one. True or false? For policies of the same coverage and term. So let's think about that $550,000 policy, 10 years. Premiums are lower if they are contracted earlier in life. So I did a 30-year-old. What if I modeled a 40-year-old? Who would pay lower premiums? Somebody taking out a 10-year policy at age 40 or somebody taking a 10-year policy at age 30? Who is more likely to die during the coverage period? Well, okay, this one's true. The younger you are when you take out the policy, the lower your premiums will be, all else equal, right, for the same policy, because you're less likely to die when you're younger. We can see that by simply going over here and making this person, say, born in 77, 30, now they're 40 years old on today's date. Calculate the quote. And that premium went up from 25 to 36, and this one went up to, I recall, being like $48 to $84. Big increases in the premiums. If I take this out later in life, I'm more likely to die, so they have to recuperate more premiums from me. So let's take this back to that person born in 19. Well, we can leave it here. We'll leave it here. Because the last one I have, true or false? All else equal, same policy, same coverage. females pay less than males. And that's true. The fact of the matter is, females are less risky than males. They just do less stupid stuff. They're less likely to speed. They're less likely to work hazardous jobs, etc. So if we go over to the quote maker, let's make this person everything the same, but make them female. Notice what happens to this 36 and 84. $36 drops to $31.77, 84 drops to $66. Much longer life expectancy for females. So now that we got a gist for how underwriting works and the different types of different ways premiums could be impacted for a term life, let's think about the other types of policies. Well, actually, before we do that, let's think about some pros and cons here. So the attractiveness of term life policies is that they offer the most coverage for the fewest dollars of premium. So take coverage divided by premium. It's the best you'll get of all types of policies. And the reason is there's no other tricks. You're just paying for life insurance for a fixed term. Of course, the disadvantage is it's temporary. If you die outside of the term, you get nothing, and you get nothing back for the premiums you paid. You pay them, nothing happens. You hope nothing happens. You hope you don't die, but you don't have that money invested, let's say. Whole life insurance brings that investment component into the fold. So just like it sounds, you're covered for your entire life. There's no term, and there's a savings component. So what that means, this is one way to visualize a whole life policy. This policy is for a person that needs $200,000 of coverage for their entire life. If they die at 40, they get $200,000. If they die at 90, they get $200,000. The difference is part of your premiums are invested into a savings account that earns a very, very modest interest rate. And so over time, your total coverage is split between the insurance company and you. So that this person that dies at age 70, they have $100,000 in their cash value account. That's their money. If they wanted to cancel the policy at age 70, they would get $100,000 minus some fees, I'm sure, back. You don't get that with term life. Your premiums aren't saved for you. Here, however, they are saved for you, and you get that back. However, if they were to die at age 70, they would get their $100,000 in death protection from themselves, and then they would get the other $100,000 from the insurance company to total $200,000. So, level insurance coverage, but you're splitting the risk with the insurance company. You're not splitting the risk, but you are splitting the bill with the insurance company. One of the reasons why they insure you for your whole life is that you put some skin in the game by saving with them. You can also do this paid up option with whole life. And that would be a contract in which, let's say you pay premiums for 30 years, and then, let me change colors here. At the end of 30 years, there's roughly $60,000 in your account. You use that $60,000 to buy a term policy for, 10 more years or the rest of your life or whatever it is. This will give you some sort of coverage. You don't have to pay premiums anymore. You just invest it in a term life policy. They call that a paid up provision. Pros and cons of whole life. It is the most expensive form it's more expensive than term life insurance. There's many different other types of life insurance policies, so I won't make the claim that it's the most expensive, but coverage per dollar of premium is higher than term life. The yields on investment are small. So this cash value, the earnings grow tax-free, but they don't grow very fast because the interest rate is very small. So you shouldn't really treat this as an investment vehicle. You should still be thinking about this as an insurance vehicle. As we see here, this is a $100,000 whole life insurance policy. The annual premiums are quite large. If you think about the $49 that this person that we studied in the Allstate quote had for 12 years, that's $588 for a much larger policy. For almost the same amount, that person, or not far off, gets far less coverage with the whole life insurance, but they have that savings component. The third type I want to talk about is universal life insurance. And let me see if I can get out of this pen. Okay. There's a good Investopedia video to help understand this. So let's check that out.
Universal life insurance is permanent life insurance that offers a savings element. Universal life policyholders have the option to pay premiums above the minimum required to cover their life insurance. The additional premium amount is invested and grows tax deferred.
And so that is a similarity and a difference between whole life. You have a cash value and you have death protection. However, you can choose how much you want to invest into your savings account. Whereas with whole life, that choice is the company's.
Providing cash value for future use. Universal life policies allow policyholders to shift money between their insurance and saving components. Premiums can even be paid using the accumulated savings. Suppose Jane purchases a universal life policy. Her required premium payment is $25 per month, but she wants to put some money away too. She pays an additional $25 each month that goes into the savings component of her policy. The older Jane gets, the more her premium costs, and less of her $50 goes into savings. After several years, she decides to draw from the savings component to help pay her monthly premium.
So that's interesting. One thing about universal life, two things that were mentioned there. One is it is almost like a single year term policy that gets renewed every year. And every year you get older, the risk you die goes up. So your premium goes up. It's not a level premium policy. Also, you can accumulate savings and pay your premiums out of savings. So, I'll show a graph here in a minute, but basically what that means is you could stop paying premiums. As long as you have the savings there, they'll just pull the premium out of your savings account. So it provides some flexibility if maybe you get some financial stress and need to not pay premiums for a while.
Interest rates in universal life insurance policies vary from month to month and typically are at high, meaning other investments might offer greater returns.
And that's a good point to reference because a lot of financial professionals will say, invest when you want to invest, insure when you want to insure, and don't blend the two. Because you can get, once again, most coverage per dollar premium out of term life, which is just insurance, and you can get better rates with just investing than if you blend the two. However, if some people like the simplicity of having it all in one place, just whatever works for you. So what that means, if we look at this graph, is basically what universal life insurance is some guaranteed coverage amount, like a term policy. However, your cash value fluctuates so that the total benefit you receive when you die is not fixed and depends on how much you have in savings. So if this person were to die at age 70, it's not a level death benefit that they get or their dependents get. They get $60,000 from the insurance company and then whatever they have in their investment account. And of course, if they're paying premiums out of their account, this could even go down as the balance falls. Now, universal life insurance policies are complex. They're not all the same. Here is a great read if you want to learn more about them to figure out if they're right for you versus a whole life or versus a term policy. All right, well, that's Module 4. Do the workshop, do your reading, do the homework, study for the quest.